Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. We are jumping straight into the deep end this week. We're looking at something a market sees less as routine and more like a major stress test.
You mean the upcoming U.S. Treasury auction, the long-term bonds.
Exactly. Billions in 10-year and 30-year debt hitting the market. And, well, analysts are pretty much all calling it a worst conditions scenario.
Yeah, the tension is definitely there,
Yeah.
and for good reason.
Yeah.
Our goal today, I think, is not just to talk about the anxieties,
Right.
but to give you a clear guide. We need to unpack the three big pressures on this sale.
And tell people exactly how to read the results, right? What makes it this litmus test everyone's talking about?
Precisely. Because it really could signal where interest rates and, frankly, the whole market might be heading next.
Okay, let's unpack this then. Before we dive into the specific indicators, what makes this particular moment right now so challenging? It sounds like more than just one issue.
Oh, it absolutely is. It's like a perfect storm, financially speaking. You've got three really powerful things hitting all at once.
Which are?
Deep political instability, a sort of structural weakness in global demand for these bonds, and just a massive amount of supply they have to sell.
Okay.
And these are all tangled together.
Yep.
So the government's asking buyers to commit for, decades.
Right, when the buyers are most nervous.
Exactly. Peak skepticism.
Okay, let's take the first one. Political disaster. That sounds dramatic, but we are in a government shutdown right now. Started October 1st, still going. How fast does that kind of domestic mess turn into actual financial fear?
Instantly. It's immediate. Think about it, buying a 10-year or especially a 30-year bond. That's a long-term bet.
A bet on stability.
A bet on the reliability of the U.S. government.
Yeah.
So when that same government can't even pass a basic budget, something it has to do, well, it makes investors question the issuer's fundamental trustworthiness.
Yeah, I can see that. If they can't manage today's budget, what about 15 years from now?
Precisely. It hits the perceived creditworthiness of the asset itself. It adds risk where there wasn't supposed to be any.
And the political talk around it isn't helping, is it? We've seen President Trump mention maybe using this shutdown to lay off unnecessary personnel.
Right. And that kind of talk just fuels the pessimism, doesn't it? It signals to the market that maybe this instability isn't just a blip, maybe it's sticking around. But beyond the headlines, there's a really practical problem the shutdown creates for investors.
Which is?
An information vacuum.
Yeah.
Key economic data, like the jobs reports everyone watching,
Yeah, those are crucial.
they've stopped. They're halted. So investors who normally use that data to figure out inflation, interest rates, the future, basically.
They're flying blind.
Exactly. It's like trying to land a jumbo jet in thick fog with no instruments. You're asking them to make multi-billion-dollar long-term bets with zero visibility.
So that lack of data just makes everyone cautious.
Super cautious. And caution means you're less likely to jump in and buy long-term debt.
Okay, that really sets the stage for the second threat you mentioned, which I agree is fascinating. Structurally weakened demand. You said traditionally, foreign central banks like China and Japan are the big anchor buyers here. What's going on with them?
Well, we're seeing what some call a buyer exodus.
Yeah.
And it seems to be picking up speed. There are a couple of reasons.
Like the U.S.-China tensions.
Definitely. Political and trade tensions play a big role. But also just the sheer size of the U.S. national debt. It keeps growing. And that worries these big institutions.
Yeah, they're backing away.
Systematically, yes. They're reducing their reliance on the U.S. dollar, and that means reducing their holdings of U.S. Treasuries. It's that whole de-dollarization trend we hear about.
And where are they putting the money instead?
We see them increasing gold reserves, diversifying into other currencies, other assets. They're moving away from what they used to see as the only truly safe place to park money.
And this leads to that really striking point from the sources about U.S. Treasury yields now being higher than some top-tier corporate bonds, like Microsoft.
Yes, that detail is potentially huge. For decades, U.S. Treasuries were the definition of risk-free, the benchmark.
The safest thing you could possibly own.
Exactly. But now, the interest rate the U.S. government has to pay the yield is actually higher than what a super stable, cash-rich company like Microsoft offers on its bonds.
Is that just a weird blip in pricing, or is something fundamental changing? Is that risk-free label cracking?
That's the million-dollar question, isn't it? I tend to think it's more the latter. It feels like a potential shift.
Why?
Because when the market perceives that lending money to the U.S. government is riskier, or at least requires more compensation than lending to a powerhouse corporation like Microsoft, Well, that's a major blow to confidence.
Hmm.
It tells you investors are demanding a bigger risk premium for holding government debt. It sort of rewrites the rule book on safe havens.
And it justifies why those foreign central banks might be reducing their holdings.
It certainly looks that way, gives them cover, you could say.
Okay, so we have political chaos making things uncertain, and we have key foreign buyers getting skeptical. Now, layer on top of that, threat number 3, overwhelming supply volume.
Right. Because the Treasury doesn't get to choose when to borrow. They have bills to pay, old debt rolling over. They have to sell this stuff.
And the amounts this week are big?
They're significant, yeah.
Mhm.
We're talking $39 billion in 10-year notes and another $22 billion in 30-year bonds. That's a lot to absorb in 1 week.
Especially when demand is shaky.
Exactly. So you've got tons of product to sell, but the pool of eager buyers is smaller and more cautious. That creates what's called a supply dominance market.
Meaning the buyers have the power?
Pretty much. Imagine you're trying to sell your house. You have to sell it this week, but only a couple of people show up to the open house, and they know you're desperate. They hold all the cards. The Treasury's in a tough spot.
Okay, this is where it gets really practical for listeners. Let's zero in on how to read the results. The auctions are Wednesday for the 10-year, Thursday for the 30-year. You called it a litmus test. What are the key things to watch? Indicator 1, the bid-to-cover ratio.
Right. The bid to cover it, think of it as just a simple measure of demand. How many dollars worth of bids came in compared to the amount the Treasury was actually selling?
So higher is better, means more people wanted it.
Exactly. A healthy auction usually sees demand significantly higher than supply. You want to see lots of bids for every bond offered.
And what's a normal number? The sources mention around 2.3 to 2.5 times.
Yeah. For these longer-term bonds, that's been the recent average range, somewhere in the low to mid-twos.
So what's the red flag? What if it comes in way below that, say under 2.0?
That's a definite warning sign. A ratio well below average means the big banks and dealers who actually buy this stuff initially really struggle to find end buyers.
They couldn't place it all easily.
Right. It suggests they were bumping up against the limits of available cash or willingness to buy. It signals weak underlying demand, and the stock market will notice that immediately.
But couldn't dealers manipulate that ratio sometimes? If they're unsure about the price, maybe they hold back a bit? How reliable is it when things are this tense?
That's a fair question. Dealer tactics can muddy the waters a bit. But look, if dealers are uncertain, they usually bid less aggressively anyway. So even if it's noisy, a dramatically low ratio still tells you the overall appetite just wasn't there. Which brings us nicely to indicator number 2.
Indirect bidders. This tracks the overseas share, right? The foreign central banks and institutions we talked about.
Exactly. This is less about the immediate auction mechanics and more about that structural trend. Indirect bidders largely represent that foreign demand.
So what are we looking for here?
A noticeable drop. If the percentage bought by indirect bidders falls significantly compared to recent auctions, it's real-time confirmation that those big, long-term foreign buyers are stepping back.
And that confirms the de-dollarization worry.
It strengthens that argument, yes. It suggests the U.S. is losing some of those foundational customers, the ones who historically bought and held for stability. That's a deeper, more structural issue than just, say, the shutdown.
Got it. Okay, indicator number 3. This sounds a bit more technical. The high yield and the tail.
Right, so the high yield is just the actual interest rate the Treasury ends up paying on the bonds sold at the auction. It's the highest yield accepted to sell the full amount.
And you want that to be close to where the bonds were trading right before the auction.
Ideally, yes. If it jumps much higher, it means the market forced the Treasury to pay more than expected. Now, the tail, that's the really telling part.
Explain the tail again.
It's the difference between that highest yield needed to sell the last bonds and the average yield of all the winning bids.
You used a furniture auction analogy before. Can you recap that?
Sure. Imagine selling $50,000 of furniture. Most sells near your target price. That's the average yield. But the last few unwanted pieces, you have to slash the price, offer a huge discount just to get them out the door.
That discount is the tail.
Exactly. A wide tail on a Treasury auction means the Treasury had to offer a much higher interest rate, a big discount on the final chunk of bonds, just to entice the most reluctant buyers to take the rest of the supply off their hands. It signals desperation.
And that means the government's borrowing cost just went up significantly.
Precisely. A wide tail is very close to what people call an auction failure. It means the market really squeezed the Treasury and demanded a high price to absorb the debt.
Okay, so if we see these negative signals, low bid to cover, falling indirect share, a high yield with a wide tail, what's the immediate knock-on effect for the stock market? How does that chain reaction work?
It's pretty quick and direct. A poor option signals higher required interest rates on government debt. That new higher Treasury yield becomes the benchmark.
The floor for everything else.
Right. It effectively raises the borrowing cost for almost everyone, especially corporations. Higher borrowing costs for companies mean lower future profits, maybe less investment, slower growth.
And the stock market hates that.
The stock market absolutely hates expensive money. So bad auction results tend to put immediate downward pressure on stock prices.
So putting it all together, what's the takeaway for someone managing their own money right now? We've laid out the threats, the indicators, but how do you actually navigate this, especially when the risk-free asset is suddenly a source of risk?
Well, first, you have to recognize the big shift in what's driving the market right now. It's not really Fed policy, is it? It's not even the usual economic data.
You're not getting the data because of the shutdown.
Exactly. So the insight here is that the market's direction, day to day, hinges almost entirely on one question. How long will this shutdown last? It's become the dominant variable.
So investors almost need to think like political analysts first, economists second.
For the moment, yes, you have to weigh the political probabilities. And that uncertainty, that paradox of the safe asset being risky, highlights the value of genuinely defensive strategies.
Okay, let's talk specifics. Strategy A you mentioned, cash is king. How does that work practically? Just hold dollars.
Holding actual cash gives you maximum flexibility, maximum protection against volatility. But practically, yeah, you can achieve that safety with things like very short-term Treasury bills, T-bills maturing in days or weeks.
They're too short to be really hurt by these long-term rate moves.
Exactly. Or high-quality money market funds that only hold those ultra-short government securities.
Yeah.
The goal is to protect your principal from these swings and, crucially, have cash ready.
Ready to buy if the volatility creates opportunities.
Precisely. Keep your powder dry, as they say.
And strategy B gets back to that Microsoft comparison irony, looking at ultra-prime corporate bonds as maybe a safer safe haven right now.
It's a fascinating pivot, isn't it? If the government's creditworthiness is being questioned because of political dysfunction, investors naturally look for stability elsewhere.
And find it in super strong companies.
Right. Companies with top-tier credit ratings, AAA or AA+.
Yeah.
Think Johnson & Johnson, Microsoft firms with bulletproof balance sheets, global businesses, tons of cash, very little relative debt.
So the thinking is, their financial health is more predictable right now than the U.S. government's budget process.
That's the calculation many are making. These companies' bonds might even offer slightly better yields currently, and their ability to pay is completely separate from the chaos in D.C.
So for someone looking for safety and fixed income, shifting some allocation there could make sense.
It's a viable defensive move, yes. You maintain very high credit quality, but sidestep some of that specific political risk tied to long-term treasuries right now.
Okay, so wrapping up, this week's Treasury auction isn't just noise. It's a really critical test facing that triple threat, the shutdown, weak demand, big supply.
Absolutely.
And for tracking it, you need to watch those three things: bid to cover ratio,
The indirect bidder share.
and that high yield, and especially the tail. Get those results, and you get a sense of the market's real health.
And the implication seems to be a cautious stance, leaning into cash or maybe those ultra-prime corporates.
Definitely a defensive posture, makes sense.
And maybe one final thought to leave people with, thinking longer term. This whole situation, especially the weak foreign demand, points to that bigger structural shift, de-dollarization.
Right.
So the provocative question is, if the U.S. government keeps eroding trust, not because the economy is weak, but because of political gridlock, what does that mean for the dollar's dominance globally in the long run, even after this specific shutdown ends?
That structural pressure might linger regardless of the immediate crisis. Something to definitely keep an eye on. Don't forget to subscribe and hit that like button.